Hello everyone, good morning. Welcome back to our corporate accounting marathon. Okay, today is our fourth day of marathon. We have already done previous three marathons with all the important chapters from exam point of view. We solved all the exam questions, and today I am back, okay, with one more such marathon in which I will be teaching you all the important concepts of the chapter along with the solutions and problems with past exam questions and some more practice questions. You all can solve them as a homework also. Okay, so if you all can hear me and my screen is audible to you, I just need a thumbs up. I'm audible and my screen is visible to all of you all. If you all can just, whoever is there can just put a thumbs up so that I can begin. Okay. Okay. So, welcome everybody for this one more interesting and helpful marathon for corporate accounts. Okay, like we have already done some more previous marathons on important chapters from exam point of view. I am now coming up with another very important chapter. Trust me, with this chapter and the previous three marathons which I have already shared with you all, if you all do this, okay, out of your 60 marks of your corporate accounts, easily your 45 marks to 50 marks is being covered totally. Okay, so today this is my favorite chapter. Okay, it is ratio analysis. Okay, ratio analysis, it is one of my favorite chapters. Why? Because it really is very interesting. It is very helpful. Okay, it helps you understand the financials, P&L, balance sheet, trading, profit and loss account, everything we have been doing since a very long time and we all know what it is. Okay, but to understand the financials from within, to understand how much actual profit or loss or what is a return on the assets or on equity, how much is a debt, how much is our equity, in order to understand in details, ratio analysis is the most important management tool. Okay, so it in practical way, this is more often used. So if I am an investor and I want to invest, I would kindly go ahead and see all these financial ratios instead of just reading the P&L and the balance sheet which just gives us the figures. Okay, we need to understand the relationship between the figures, right, of the entire financial statement. In this I have prepared these notes. Okay, again the same way like how I have done for my previous marathon classes. I have already solved all the questions for you. Okay, so we are going to solve a few questions which I have taken from the module. There are some questions, then there are all the past exam questions until now covered, and there are some practice questions. Okay, those practice questions, they are in form of MCQs because previously this paper was an OMR based. But I have kept those questions. Why? Because they are very useful, and now also they keep asking this type of questions, though it is a descriptive paper. They will not give you options, they will ask you to solve. That's the only difference. Okay, so we are going to solve those questions also, because based on that, they give big questions in the exam. So I am going to first take you all through all the ratios. I have made a list of all the ratios. Okay, I will explain you all the ratios quickly, and then we will go to the solving of the problems. Okay, this chapter is basically completely practical. Okay, there is no such theory to it. However, they might ask you for 2 to 5 marks to interpret a ratio, to give us the analysis based on the ratio you have done. So that you will have to understand and write it. So if you will know what this ratio is all about, you will be able to interpret the ratio also. Okay, so quickly I will take you all through to all the ratios. Important ones I will explain, and the others you all can just go through. Okay. So starting with the profit margin ratios. Now this part A, if you all have seen, I have written this as part A. Why? Because they are about profit margins. This is one of the most important types of ratios. They generally keep asking you gross profit margin, net profit margin, all those type of things. Okay. So gross profit margin means what? How much percentage of gross profit we have. Margin, we will always calculate the amount of gross profit we made upon the net sales or sales into 100. It is in form of percentage. Higher the ratio, better. That means you are making more profit against your sales. So your sales, your turnover can be 1000 crores. But if your gross profit is only 1 CR, that means you have got a lot of expenses. Correct? Then net profit margin is actually your net profit after tax. Everything you have completed paying upon your, again, sales or net sales into 100. Okay, so gross profit margin and net profit margin. Operating expenses ratio, again same thing, all your operating expenses which you are needing in your day to day, okay, yearly operation related, okay, to your sales. Not any other kind of inoperating expenses, only those which are related to your operations. Divide that by 6. Operating expense ratio. Then you have operating ratio. The difference between two of them is operating expense talks about all those operating expenses which have gone into your P&L. They are not a part of your trading and COGS. Okay, and operating ratio is your operating expenses plus your cost of goods sold. Divide that by sales into 100. Okay, so gross profit and net profit, because they talk about profits, obviously higher, more the better. Expenses ratio, lower the better. Okay, quickly I am moving to the next part, which is B, capital ratios. Okay, now in capital ratios, these ratios are also very important, this B section. Okay, in that the first one, return on investment. This is the favorite question of our institute. Return on capital employed, return on investment. Okay, return on capital employed means what? What is your actual amount of capital which you are using to run the business? Okay, or amount of, so your capital employed is nothing but your shareholders funds, which is your equity share capital, preference share capital, your reserves and surplus, everything belonging to your shareholders, plus any kind of borrowed funds, capital employed. Okay, that ratio you can find only with the help of NPBIT, net profit before interest and tax. Which interest? Before long term and short term borrowing interest which we have. So we have to make an income statement. From there we will be able to take our NPBIT, divide by capital employed into 100, again in form of percentage. If I tell you return on only shareholders funds, or I tell you return on net worth, means your own capital. Net profit after tax, because that is the profit which belongs to your shareholders. So net profit after tax upon shareholders funds into 100. Return on equity, net profit actually available for equity. Not necessarily this entire net profit after tax is available for only equity. You may have preference dividend also. So you will have to remove it. Then that will be net profit available only for equity shareholders. That divided by your equity shareholders funds, that will be your return on equity into 100. This is all again in form of percentage. Which net profit? Obviously net profit after tax minus preference dividend if any. If there is no preference dividend, entire profit is for your shareholders. Return on total assets, again NPBIT. Okay, entire profit before interest and tax upon the total number of assets which you have taken and kept it in your organization and using it over the period of time. Okay, so that again in form of percentage. So return on total assets, return on equity, return on shareholders funds, and return on capital employed. 4 important capital related ratios, favorite for the institute and their questions. Okay, so I'm just giving you one format. Gross profit, whatever is your gross profit. How do you get your gross profit? You take sales or net sales minus your COGS. You get your gross profit. From there, you remove operating expenses and add your operating income. You'll get net profit before interest and tax minus your interest on short-term borrowing, NPBIT, interest on long-term borrowing. Generally, we do this only. It's short-term borrowing, long-term borrowing directly. They don't give you so much in detail. They will just give you a borrowing and interest rate. You subtract interest, you'll get net profit before tax minus the tax at whatever rate, net profit after tax, preference dividend, net profit for equity shareholders. Okay, then you can give them equity dividend since there is profit. Balance you will transfer it to P&L account. Okay. Next is your liquidity ratios. Now, in case of liquidity, 2 important ratios are there. One is current ratio and one is liquid ratio. Current ratio means are your assets, current assets, which are, what are your current assets? Those which are convertible within a period of 12 months. Okay, they will not stay in the balance sheet for years to come like fixed assets. Current ratio, your current assets like your debtors, your cash balance, your bank balance, your short-term investments, your stock, okay, bills receivable, okay, all that which are going to be within the 12 months that are going not to be there now. Okay, those are your assets. Like you will sell the stock, you will have debtors paying you, you'll have bills receivable received, cash and bank balance will change. So current assets upon current liabilities. You need to have 2 rupees in current assets against 1 rupee in your current liability. Only then I can say that this particular organization is liquid, is current. They are able to pay their liabilities with the help of their assets. It should not be other way around, of course. Then liquidity ratio, quick ratio. Quick ratio means what? All those current assets, okay, which are not quick, they cannot be easily converted into cash. Remove them. Okay, so from current assets, stock. Not necessary I will be able to sell it tomorrow. Prepaid expenses, fictitious asset. Fictitious. It does not have anything in it. It's in fact an expense. But we are writing it in the asset side. Okay. Upon current liabilities minus bank OD is not actually your current liability. Okay. It's like your overdraft facility, your credit card facility, right? So all the current assets, but remove stock and prepaid expense, and from current liability, if there is any bank OD, this is known as short-term borrowings. Remove that. You will get the liquid ratio. So standard ratio is 1:1. And for current ratio, it is 2:1. Then there is absolute cash ratio. This is not very important, but I'll explain you what is absolute cash means. Cash and cash equivalents means cash in hand, cash at bank, plus your short-term investments which can be easily converted into cash upon current liabilities. Again, it will be in form of is-to. Okay, there is no standard in this. And then there is defense interval ratio. Defense interval ratio is always in days. Means in how many days are you able to, pay your daily operating expenses, kind of. So you have your cash and bank balance plus your short-term investments. This is the amount of cash you actually have upon your daily operating expenses. That will be your difference interval ratio. Now these ratios, they don't generally ask, very rare, but I am explaining and keeping it to you. Okay. Then you have stability ratio. In stability, we have long-term and short-term stability. Long-term debt equity ratio. This is, without this, we will never be able to do any sum. Why? Because for every 2 rupees of debt, they say 1 rupee of equity is what is standard. Borrowed funds upon shareholders' funds, debt equity ratio. This is the standard. Okay, so basically you should have 2 rupees of debt against your 1 of your own fund. Then you have capital gearing ratio, your fixed return bearing security. Okay, divide by security not having fixed return. Which is your fixed return security? One is your borrowed funds, long-term debentures, bank loan, plus your preference share capital. Fixed return you have to pay them, whether you make profit or no. Divide by security not having fixed return, shareholders funds minus preference share capital. So this you all can go through it later, read it. Okay. Proprietary ratio, entire shareholders funds upon your total assets. Okay, how much of your own funds are you using against your total assets? That will give you the proprietary ratio in form of percentage. Proprietary, own. So own funds, shareholders funds is own funds upon total assets into 100. Standard is 60% is to 70% minimum. Okay. Come on. Next is your turnover ratios. Important. Turnover, everything relating to your revenue and sales. Okay, revenue, sales, one and the same thing. Okay. Capital turnover ratio. All these ratios you will find sales at the numerator. Turnover, it is always sales at the numerator. Capital turnover means sales upon capital employed. It will always be in dash times. 5 times, 4 times, 2 times. Okay. Asset turnover. How will you remember turnover? So sales upon, what is the word? Total asset. So sales upon total assets. Fixed asset turnover, if I tell you, I can remove these ratios in any form. Fixed asset turnover, sales upon fixed assets. So total assets, fixed assets, capital employed. Debtors turnover. Okay. Debtors turnover will be your credit sales. How is debtors generated? Not from all the sales, not from entire revenue. Only if you are selling goods on credit. So credit sales upon your average debtors plus bills receivable. Average means what? Opening plus closing divide by 2. If nothing is given as opening closing, then I will just take the figure which I have with me in the balance sheet. Okay. Stock turnover, same thing. Cost of sales, or you will have COGS. Okay. Upon your average stock, opening stock plus closing stock divide by 2. Okay, you can have cost of sales or COGS, whatever they have given you. That will give you a stock turnover ratio. Creditors turnover ratio, it generates because of credit purchases, na? So credit purchases upon your average bills, payables and creditors. Dash number of times. And debtors collection. Now this based on your turnover. Now you have collection also. In how many days are you able to collect the debtors money? That means you will take your ratio of average debtors plus bills receivable divide by credit sales into, if it is 12 months or 2 weeks or days, whichever we will take. So debtors velocity lower the better. That means I am able to get money quicker. Okay, so I will get that collection period in number of days or weeks or in months. Okay, I have to just kind of turn the formula. See, it is the reverse. Average debtors plus bills receivable upon credit sales. Same is stock holding period. For how many days I keep the stock in the company before selling. So again, reverse. Average stock upon your COGS into 1252, 365, whatever is given in the question. lower the better. And creditors payment period, in how many days I am able to pay my creditors. So average creditors plus bills receivable, or sorry, bills payable upon credit purchases into 1252 or 365. Higher the better, means I am getting more time, more days or months to make the payment, or more credit period. So the greater the credit period, better for the company, right? Then investors ratios or market based related ratio. This is all about earning per share, dividend payout, all that. So earning per share is all the profit which is now available only for equity shareholders upon total number of equity shares. That will be your earning per share. Dividend per share will be the amount of total dividend upon number of shares. Dividend payout ratio is always in percentage. So total dividend upon the net profit for shareholders. Total dividend, how much dividend you are paying upon the total net profit available for equity shareholders, will give you a dividend payout ratio. Price earning ratio, market price per share upon earning per share. This is lower the better. Means what? If this ratio is less, it means that I will be able to reach the market price faster with the help of this earning. Okay, earning per share means what? The company is availing this much of profit now for equity shareholders, divide by number of equity shares. That earning and market price, if I compare, how much times it will take to reach to that market price. So the less time it takes, it is better. And then dividend yield ratio is dividend per share upon market price per share. Higher the dividend yield ratio, that will be better. Earning, again, yield ratio means what? You will take dividend in the numerator, yield means market price. Earning yield ratio, earning in the numerator, earning per share, divide that by market price per share into percentage. Higher the better. Yield, higher the better. Price earning ratio, lower the better. Okay. Then NPBIT interest, NPBT tax, net profit after tax, preference dividend, net profit for equity shareholders minus equity dividend transfer to P&L. Sales is what? COGS plus gross profit. These are certain important formulas. What is working capital? Working capital is your current assets minus your current liabilities. Okay, say if you do not have any kind of borrowed funds, there is nothing there in the borrowed funds, then you can say your working capital is nothing but shareholders funds minus fixed assets. This is used very rarely when borrowed funds is zero. Okay, so your shareholders funds minus your fixed assets will actually give you working capital. What is average stock opening plus closing? Divide by 2. And COGS is nothing but all your expenses relating to your trading. Okay, so opening stock plus purchases, then you might have some kind of wages, etc., all related to your trading account. Okay, so all those expenses minus your closing stock will give you your cost of goods sold. Net worth is nothing but your shareholders funds. Okay, equity share capital plus preference share capital plus your reserves and surplus. Okay, then you have some coverage ratios. These are not very important, but I'll just read them for you all. Interest coverage. How are you able to cover your interest with the help of your profit? Which profit? NPBIT. NPBIT upon interest. Preference dividend coverage. Preference dividend, you will take the profit just before preference dividend, that is NPAT upon preference dividend. Here you will take the profit just before interest, so NPBIT. Okay, here NPAT. Equity dividend coverage ratio, net profit for equity upon equity dividend, and total dividend coverage ratio will be net profit after tax upon equity dividend plus preference dividend. Okay, and debt interest service coverage ratio. Debt interest means, and service coverage ratio. So here your NPBIT plus your non-cash expense. which is depreciation. It actually does not have cash moving out. Minus your tax. After you add depreciation, then remove the tax, whatever profit you get, divide that plus upon your interest upon installment of your principal amount, debt service. Okay. So this is it with your ratios. We will keep this file very much open over here and we will try to solve our given sums. Okay. So we are good to go now. All right. Come on. Let us read this question. The following data of Vishal Limited is available for the year ended 31st of March 2007. All right. Share capital. There are 20 lakhs of equity shares of rupees 10 each. So rupees in lakhs, they have written it as 200 lakhs. Okay. General reserve 150 lakhs. Investment allowance reserve 50 lakhs. Okay. Then we have provision for dividend 10. Provision for tax 84. 15% for the long term loan, which loan amount is 300 lakhs. Profit before tax is 140. Calculate capital return employed, okay, and return on net worth and return on capital employed. Basically, they are saying return on capital employed and return on net worth. Okay, fine. So now return on capital employed. I have given you all this formula. See here, return on capital employed, just the next one, B, capital ratio, NPBIT upon capital employed into 100. Okay, so I am just writing the formula and keeping here, NPBIT upon capital employed into 100, and return on net worth means your shareholders funds. So net profit after tax upon shareholders funds into 100. Okay, I'm just writing this formula. Okay, these two formulas we have to use. Now for that I will need NPBIT, capital employed, NPAT and shareholders funds. Okay, so NPBIT, have they given me NPBIT? One second. Net profit before interest and tax? No, they have given me net profit before tax. This is given. So I will now start with, one second, I will start with, okay, I have made the statement, NPBIT minus interest, interest will be 15% on 300 lakhs, right? See, on 300 lakhs I will take 15%, that I know. NPBT is given to me. Tax is also given to me. Net profit after tax I got. Now if I want to go reverse, so this, when I go reverse, I will, net interest rate is given to me 45, no, 300 into 15% will be 45. So when I will go reverse, I will add this to 140 plus 45. Only then I'll get, no, this 185. 185 minus 45 will give me 140. Since I'm going reverse, I'll change the sign. Net profit before tax plus interest will give me net profit before interest and tax here. So I got this NPBIT, I have NPAT. I need to know my capital employed and shareholders funds. What is shareholders funds? I have told you, share capital plus reserves and surplus. So let us see what is there in share capital. We have 200 lakhs. We have 150. We have investment allowance reserve also. So 200 is your share capital. Sorry. Okay, so 200 is your share capital, 150 is your general reserve, investment allowance reserve, 400 is my shareholders funds. And capital employed will be your shareholders funds plus your borrowed funds. Borrowed funds is only this 300. Shareholders funds we just calculated, 400 plus 300, 700. All my figures which I have to put now I have. NPBIT 185 upon 700 capital employed. Percentage will be 26.43. Net profit after tax, they have given me 56. Shareholders funds we calculated into 100, 14%. such an interesting and easy sum, and this type of sums of 5 marks. You will not take more than 3 minutes to solve this. Okay, next question. From the following balance sheet, you are required to calculate current ratio, quick ratio, inventory turnover, average collection period assuming 360 days, owner's funds to the liability ratio. Okay. Now sales credit for the year is 4 lakhs. Gross profit is 1,60,000. In liability and capital, we have share capital, reserves, debentures, creditors, bills payable, other current liabilities, goodwill, plant, stock, debtors, cash and miscellaneous current assets. Okay. So, ignore this solution number and all that, okay? You just say focus on this. Question number 2 this is. Now current assets. We all know what is current assets. Current ratio is nothing but current assets upon current liabilities. Now in my question, what is current assets? Stock. Then we have debtors and then we have cash. Just added up 80,000 plus 45,000 plus 17,000 plus 8,000. Another some fixed current miscellaneous current assets is also there. All this 4 I will add, and my liabilities will be creditors, bills payables and other current liabilities 62. So I'm going to get 1,50,000 current assets. Current liabilities is 62,000. Okay. So I'll get 2.42. 2.42 is to 1 is my current assets upon current liabilities current ratio. Then they are telling me find the quick ratio. Quick ratio means liquid ratio. In case of liquid ratio, I need to know that from current liabilities I'll have to remove bank OD. But from current assets I'll have to remove stock also and prepaid expense also. So there are no prepaid expense, there is no bank OD. But yes, stock is there. How much is the stock? 80,000 here. So 1,50,000 minus 80 will be 70. Current liabilities will remain the same 62. So my current ratio is 1.13 is to 1. Okay. Then we have inventory turnover ratio. Turnover ratio. Inventory turnover ratio means COGS upon average stock. Okay, now COGS they have not given me, but they have given me sales minus gross profit will give me my COGS. So sales figure is given to me here. Gross profit is also given to me. So COGS will be 4 lakhs minus 1,60,000. Average stock. Average means opening plus closing upon 2. But nothing is given to me. Opening, closing figures are not given to me. So whatever is given to me in the balance sheet, I will take it. Okay. I will take that only. So it is going to be 80,000. So 4 lakh minus 1,60,000. 4 lakhs minus 1,60,000 is 2,40,000. Okay. Divide that by 80,000. So it is going to be 3 times inventory turnover ratio. Then they are telling me to find average collection period assuming 360 days in a year. Okay, so average collection period will be that reverse of turnover. So it will be average debtors plus bills receivable upon credit sales. Now they have not given me anything whether, no, they have given me sales is all credit. Sorry, credit sales. So 4 lakhs. Average debtors plus bills receivable, they have not given opening closing. So I will take this debtors 45. So 45,000 upon 4 lakhs into, I told you can take 12, 52, 365 depending on what is given in the question. They have told me to take 360. So I will take 360. Debtors collection period will be 41 days approximately. You will get it in point, but you will have to write approximate. You have to write the proper number. It cannot be in fraction, days. So 45,000, divide that by 4 lakhs into 360. You will get 40.5. 41 days approximately. Round it up. And then the last ratio, no, which they are telling me, so we finished with current quick inventory average collection period, owned funds to liability ratio. Okay, now in this case, they have not mentioned which liability and what liability. Okay, what I have done is owned funds to total liability I have taken. Shareholders funds. Shareholders funds will be only share capital plus reserves and surplus. So 2,50,000 upon total liability side. Okay, total liability side I have taken, which is 4,20,000. Whatever you are doing, if you are doing, own funds to liability, means you are just taking these balance liabilities. Okay, where debentures, creditors, bills payable, other current liabilities, only this you are taking. Whatever you are doing, see to it that you write a note to it. Okay, so generally institutes don't ask this type of questions. I have just kept it over here and I am asking you why, because it's there in the module. So you can write over here and that we are assuming that the liability means the total of the liability side of the balance sheet. If you are taking only liabilities, that is long-term, short-term liabilities, then you can mention it like that and give the ratio. Okay. Okay, so this question is now over. Done. Now coming to question number 3. ABC has made plans for the next year. It is estimated the company will employ total assets of rupees 8 lakhs. 50% of these assets will be financed by borrowed capital with an interest rate of 16% per year. The direct costs for the year are estimated as 4,80,000 and all the operating expenses are rupees 80,000. The goods will be sold to the customers at 150% of the direct cost. Income tax rate 50%. Calculate net profit margin, return on assets, asset turnover, return on owner's equity. Ratios are okay. First I'll have to make my income statement. Okay, so in case of income statement, write there solution number 3. Okay, for income statement, first thing, what is my total assets? How much capital I will need? 8 lakhs rupees. They have told me that we need to employ total assets of 8 lakhs. That means this is the capital also I will need, right? So that 8 lakhs, they are saying 50% with borrowed funds, interest rate 16%. So 50% of 8 lakhs, 4 lakhs. That means balance 50% is shareholders funds, equity share capital. They have not told me anything about preference share. So obviously this will be equity share capital. Direct expenses, they are saying it is 4,80,000. Okay. Now they are telling me the goods will be sold to the customers at 150% of the direct cost. Okay, direct cost is 80. No, sorry, 4,80,000. Okay, direct cost is 4,80,000. If I am selling goods, that means my sales will be 4,80,000 into 150%. Right, that will come to 7,20,000. That is my sales, that is my revenue. How did I get this? This is 150% of my direct cost. The direct cost is nothing but your COGS, cost of goods sold. Okay, which is 4,80,000. It's already given to us. Gross profit 2,40,000. Operating expense given again 80,000. Is there any operating income? Not given, 0. So net profit before interest and tax is 1,60,000. 2,40,000 minus 80, 1,60,000. Subtract interest from that. How will I get interest? 4 lakhs into 16%. 4 lakhs is my borrowed funds. So 4 lakhs into 16% is 64,000. Net profit before tax 96,000. Tax is given, is at the rate of 50%. 48,000 net profit after taxes here. So I have all the figures now which I will need in order to put it in my formula. Net profit margin, I told you, net profit after tax upon sales. Right? So net profit after tax, we just calculated 48,000. Sales is 7,20,000 into 100, 6.67%. Next, they are asking me return on assets. Return on assets means NPBIT upon your total assets. How much is my NPBIT? Here, NPBIT 1,60,000. Total assets which I need, we just did it here. This is the total assets which we will need. Capital employed, kind of. Right, 8 lakhs into 100. So 20% return on assets. Asset turnover. Turnover means sales upon total assets. Sales is 7,20,000. Assets is 8 lakhs. 0.9 times. This is always in times. Turnover ratios. Return on equity will be the profit available for equity shareholders. I think this will be the profit, net profit after tax itself. Profit available for equity shareholders upon the equity shareholders funds. Entire 4 lakhs is your equity shareholders funds. Nothing is given to me about reserves and surplus and anything. So that total 4 lakhs I am considering. Net profit for equity will be your net profit after tax only in our case, and divide by 4 lakhs into 100, 12% is net profit on equity. Okay, so we are done with this also question. Easy one. Easy questions. If we will practice this, we will be able to solve the past exam questions quickly. Past exam questions, no, in case of ratio analysis, always keep in mind, they will give you big question. They will write entire history, geography of some kind of a company who is not doing well, and now they want to revamp the company. This is something standard which they ask. Even in my time when, this paper was a descriptive paper, okay, ratio analysis used to be this type of questions. Don't get scared thinking, oh my god, such a big question. When you will solve, no, it will be hardly anything. So much of details are already given in the question. You have to pick the figures from there and put it in the formula. That is all. Okay. Now next, question number 4. I will not waste much time. We have a lot of questions to be solved. Question number 4. From the given information of ABC, okay, they have told me working capital 1,20,000. Working capital means what? Current assets minus current liability. Reserves and surplus is 80. Bank OD is 20. Fixed assets to the proprietary ratio is 0.75. Current ratio 2.5. Liquid ratio. Now they have given me the ratio. So what they want from me? They want the assets, liabilities and stock. Okay, so now this is reverse ratios. Okay, basically they have given me the ratios. They are telling me to find the amounts. Until now we had the amounts and we were finding the ratios. Okay, question number 4. Alright, I need to find assets, liabilities and stock. For assets, I can take this, no, current ratio. Current assets upon current liabilities. Let's start with something, no. Current ratio will be nothing but current assets upon current liabilities. Ratio is given to me as 2.5 upon current. I don't know current assets amount. I don't know current liabilities amount, but I can write it, no. Current assets is nothing but equal to 2.5 of current liability. This one equation I got it. Right, no. Current liabilities, if we will take on the other side, current assets will become equal to 2.5 of current liability. Next, they have given me something about working capital is 1,20,000. Working capital is nothing but current assets minus current liabilities. 1,20,000. Instead of current assets, I am writing 2.5 of current liability from this equation. Minus again current liability. 2.5 current liability minus 1 current liability will be 1.5. Take that 1.5 in the denominator on the other side. So 1,20,000 divided by 1.5 will give me my current liabilities, which is going to be 80,000. So current liability figure is done. That I can put it in this equation, 2.5 into 80,000. That will give me my current assets. So I got current assets, I got my current liabilities. Now in case of liquid ratio, I need stock, right? Liquid ratio is given. Current assets we just found out. Stock we don't know. Prepaid expenses is 0. Divide by current liabilities. Bank OD they have given to me 20,000. Now I can do it. Okay, this is going to become 60,000. So 1.5 into 60. I'll take it on the other side. And 2 lakhs minus stock. When I'll bring stock on this side, negative will become positive. 2 lakhs minus 60 into 1.5 is 19. So stock is going to be 1,10,000. Okay. So I got current assets, current liabilities and stock. Fixed asset proprietary, they are just given me to confuse. Okay. Done. All the amounts are here. Fine. Now next question number 5. From the information of XYZ Limited, find the below. We have to find amount of sales, amount of fixed assets, capital employed, debtors, creditors, purchases, opening and closing stock. Everything we have to find. Okay. Stock turnover is 6. Fixed asset turnover is 4. Capital turnover is 2. Gross profit 20%. Debtors collection period 2 months. Creditors payment period 73 days. The gross profit is rupees 60,000. Closing stock is equal to 5,000 in excess of the opening stock. Okay. Fine. First I will start with whatever I have. I have got gross profit. Gross profit will help me find the sales amount. How? Gross profit margin ratio. Gross profit margin is nothing but gross profit upon net sales into 100. I don't know my net sales. So I'll bring that on the other side of the equal sign. Gross profit upon gross profit ratio. Gross profit is given. Gross profit ratio is also given. See, here they have given me 20% and 60,000 of gross profit. That means my net sales is 3 lakhs. One thing is done. Since I have my sales, I have my gross profit. COGS is easy to find. Right? COGS will be how much? 3 lakhs minus 60,000. That will be my 2,40,000 as my COGS. Okay. I have done something which I know you all are little curious to know. Gross profit is 20% of the sales. I generally have a habit of writing this formula because you can use it. Whenever the profit is as a percentage of sales, assume sales as 100. If the profit is as a percentage of cost, then assume cost as 100. So if I am saying 20% of sales, that means 100 will be sales and 20 will be the profit. So what will be this remaining will be COGS. You can do cross multiplication and also find the COGS amount. Okay. Then we have fixed asset turnover. Asset turnover means sales upon fixed assets. Right. So now I have sales figure. They have given me this ratio. With that I can find my fixed asset. Turnover is 4. 3 lakhs is sale. Fixed assets. Fixed asset will be 3 lakhs upon 4. 75,000. Capital turnover. I have my turnover. Sales. Ratio also they have given me 2. So with that capital employed will be 1,50,000. Okay. So basically I am done with finding sales amount. The moment I got my sales amount, I got my fixed asset also and I got my capital employed also. Now debtors and creditors. That I can do it with the help of the collection period. Okay. Debtors collection period is the reverse of the turnover. No? So average of debtors upon credit sales into 12 I will take because they have given to me in form of months. Debtors collection is 2 months. Average debtors means debtors only now. Okay. There is no opening closing over here. So debtors upon credit sales, entire sales is assumed to be as credit into 12. So debtors will be what? 2 into 3 lakhs. Okay, 3 lakhs will go on the other side. 12 will come on this side. So it will be in form of division. So 2 into 3 lakhs divided by 12. Debtors will be 50,000. Similarly, I will do the creditors payment period. Nah, but creditors payment period, I don't know the creditors also and I don't know the purchases also. This they have given me 73 days. But what about purchases? We know one formula, no? COGS is opening stock plus purchases minus closing stock. Right? COGS we found out. Opening stock, assume it to be X. Assume opening stock as X. So X, purchases also I don't know. Closing stock will be what? It is 5,000 plus of the opening, excess. Means 5,000 plus X, no? So opening stock plus 5,000 will be my closing stock. Okay, now 2,40,000 is equal to X plus purchases minus X minus 5,000. When you will open the bracket, okay, when you will open the bracket, it will become 2,40,000 will be X plus purchases minus X minus 5,000, right? So minus X plus X cancelled. This minus 5,000, if I'll take it on the other side, it will become plus. That will be equal to purchases. So 2,45,000 will be the purchase. So purchases I have, creditors I don't know. I know the credit collection period. Into 365 I'll take. Why? Because this is in days. Right? So 73 into 2,45,000. Divide that by 365. 49,000 will be our creditors. Superb. So we got the figure of debtors and creditors also now. We got purchases also. Now opening stock and closing stock. Stock turnover ratio. Okay. Stock turnover ratio is COGS upon average stock. Stock turnover ratio they have given me is 6. COGS is given. Or sorry, we have found out. Upon average stock. So average stock is 40. Why is 2,40,000 divided by 6? 40,000. Average stock is nothing but opening plus closing upon 2. Opening I had assumed X and closing will become X plus 5,000 upon 2. Right? Now average stock is 40,000. So 40,000 will be equal to X plus X will be 2X plus 5,000 upon 2. So this is going to become 80,000, 40,000 into 2. Okay, minus 5,000 will become 2X. So 75,000 divided by 2 will be equal to X. So 37,500 is going to be my opening stock. Therefore, closing stock will be 37,500 plus 5,000, 42,500. Okay. So, question number 5, question number 5 is also done, opening stock, closing stock. So, all this we have to just use in order to find the answer. Okay. Now, some practice questions I have taken. Quickly we'll solve. Okay. N Limited has a net working capital of 119 lakhs. Total liabilities is 225. Non-current liabilities is 140 lakhs. We have to find the current ratio. That means we need current assets and we need current liabilities. Okay. So, net working capital given, total liability given, non-current liability given. Current liabilities will be what? From total, if I will remove non-current, I'll get current. Both is given, no? Total is given 225 and this is also given. Current liabilities is nothing but total liabilities minus non-current liabilities. Both is given 225 minus 140. Okay. So 140 minus No, sorry. It has to be 225 lakhs minus 140. That will give you 85 lakhs. I got my current liabilities. Okay. Now they have given me my net working capital. Working capital, I told you, it is current assets minus current liabilities. You have net working capital, you have current liabilities. So current assets will become what? Working capital plus current liabilities. So current assets is 204 lakhs. Therefore, current ratio 204 upon 85, 2.4 is to 1. Okay. Next, Mahi Limited, they had a closing stock of 648 lakhs and prepaid expenses 32 lakhs. Total liquid assets are 1830 lakh. If liquid ratio is 1.5 is to 1, then working capital will be, for working capital again I need as current assets and current liability. Okay, now given is current closing stock they have given me. They have given me prepaid expense and they have given me liquid assets. And they have given me the liquid ratio. This is all given. I need to find working capital. For working capital, I'll need current assets and current liabilities. Okay. Now, what is current assets? Current assets will be all your liquid assets plus you do your stock plus your prepaid expense. So, liquid assets is given, stock is given, prepaid expense given. I got my total current assets. Now I'll put this ratio. Liquid ratio is liquid assets upon liquid liabilities, which is equal to 1.5 is to 1, right? So liquid ratio 1.5. Liquid assets means what? Current assets minus stock minus prepaid expense, okay, upon current liabilities. So this current liabilities I don't know, so it will go in the liquid. There is no other kind of liquid bank OD or something. If bank OD is not there, if there is no bank OD, okay, so your current liabilities and liquid liabilities become the same thing, right? So 1.5 into current liabilities will be 2510 we found out, minus 648 minus 32. So 1830, divide that by 1.5. 1220 will be your current liabilities. So working capital, current assets minus current liabilities 1290 lakh. You all can practice this sum again as homework. Okay. Following are the details of Beta Limited. Equity share capital 10 rupees each, 8% preference share, 12% debentures, profit before interest and tax, dividend payout ratio, price earning ratio is 25. Corporate tax 30%. What will be the earning per share? For earning per share, I need to find the profit available for equity shareholders. Divide that by number of equity shares. Now, number of equity shares I'll get from here 1500 lakhs. Divide by 10. 150 lakhs are the number of shares. Fine. So, particulars and amount in lakhs. I will start with profit before interest and tax is given to me. 590. Minus interest. Again, this is given 12% of 250. 30. Profit before tax. At the rate of tax, which is 30%, profit after tax. Preference dividend is 8% of 400. 8% of 400. 32. So profit available for equity shareholders 360, divide by number of shares 150. So 2.40 per share. From the following information, calculate net profit ratio. Gross profit is 1/4 of the cost. Okay, and sales is rupees 2 lakhs. Indirect expenses is 12%. Okay, net profit ratio we need. Alright. Gross profit 1%, 1/4 of the cost. 1/4 means 25%. Sales given, indirect expense given. Cost plus gross profit will give me sales. COGS plus gross profit will give me sales. Okay, they are telling profit is 25% of the cost. So then I'll assume cost to be 100. This is 25. So sales will obviously become 125. They have given me the sales figure 2 lakhs. So what will be my gross profit? I'll cross multiply. Okay, 2 lakhs into 25 divide by 125. My gross profit is 40,000. Therefore, since I got my gross profit and they have given me all the indirect expenses, my net profit will be, from gross profit I'll remove my indirect expense, 28,000. I have my net profit, I have my net sales. Net profit is 28, sales is 2 lakhs into 100. 14% is my net profit margin. Such easy sums. Next, from the following information pertaining to A, current ratio, acid test ratio, current liabilities 31 lakh. Find out the value of inventory stock. Okay. So current ratio is nothing, current assets upon current liabilities. So current assets into current liabilities is your, current ratio into current liabilities is current assets. Current liabilities they have given me, current ratio also they have given me. Therefore current assets is 124 lakhs. Liquid ratio is nothing but current assets minus stock upon current liabilities. Liquid ratio is also given to me. Acid test ratio means liquid ratio. Okay. So liquid ratio is equal to current assets minus stock upon current liabilities. Current liabilities is so given. Current assets we just found out 124 and assume stock to be X. Now solve this equation. 2.8 into 31, 124 minus X. Take X on the other side, it will become positive. 124 minus 2.8 into 31 is 86.8. So stock will be 37.2 lakhs. Okay. Next question. P Limited furnished the following information. COGS rupees 6 lakhs, net profit is 3 lakhs, sales return is 1 lakh. Okay. If the net profit margin is 25%, then what will be the gross profit margin? Net profit margin and net profit both is given. Net profit and net profit margin both is given. With that I'll be able to find my sales. Right? Net profit margin is equal to net profit upon sales. So sales will be 3 lakhs upon 25%. Okay, 12 lakhs. So gross profit margin will be how much? Gross profit upon sales. Okay. Gross profit margin will be gross profit upon sales into 100. What is gross profit? Sales minus COGS. Sales is 12 lakhs. We just found out with the help of the formula. And COGS is 6 lakhs. So 12 lakhs minus 6 lakhs upon 12 lakhs. That will be 50%. Next question. Equity share capital 25 lakh rupees. Face value is 100. Profit for equity shareholders is 5 lakh 15,000 rupees. Earning per share is what? Profit available for equity shareholders 5 lakh 15,000. It is 5 lakh 15,000. Huh? Please correct it. Yes, it is 5 lakh 15,000. Number of equity shares will be how much? 25 lakhs divided by 100 is 25,000 shares. 20.60 per share will be my earning per share. Keeping this same information, dividend payout ratio is 40%. Price earning is 30 rupees. What will be the dividend per share? Dividend per share will be 40%. So earning per share I have already got, na? 20.6 into 40%. That will be my dividend per share. Whatever earning the shareholders are having per share, some is kept in form of dividend payout. 40% we are giving as dividend. So per share dividend will be 40% of 20.6. 8.24 per share will be the dividend payout. Okay. Now next, 9. Profit before interest and tax of AB Limited is 3 lakh 40. Their net fixed assets is 2 crore 10 lakhs. Working capital 27 lakh 70,000. What is the return on investments? NPBIT is given. Fixed assets are given. Working capital given. What is return on investments, NPBIT, upon total capital employed, right? If capital employed is not given, I can take net fixed assets upon working capital. Same thing, it will make the total, no, net fixed assets plus working capital is what? Current assets minus current liabilities, no? If you see this T form of the balance sheet, here first we have equity share capital, then borrowed funds, then we have current liabilities. Here we have fixed assets and we have current assets. Current assets minus current liabilities is working capital, and we take fixed assets over here. It will become the same thing, no? Capital employed. So 3,40,000 divided by 2 crore 10 lakhs plus 27 lakh 70,000, 2 crore 37 lakh 70,000, 1.43%. Yeah. Okay. Debtors velocity 3 months. Sales 25 lakhs. Bills receivable 60,000. Bills payable 36,667. How much is the sundry debtors? Okay. With the help of debtors velocity, average accounts receivable, that is average debtors plus bills receivable upon credit sales. Now this average debtors bills receivable, I'll say it is average, it's debtors amount. Okay. So debtors velocity is 3. I don't know this average accounts receivable. Credit sales is given to me 25 lakhs and I can take months. So it is 12 months. So 3 into 25 lakhs divided by 12 will be X. So I'll get average accounts receivable is 6,25,000. But they are not asking me average accounts receivable. They are asking me debtors. Okay, they are asking me the amount of debtors. So average accounts receivable, or you can say accounts receivable, is nothing but debtors plus bills receivable. Now accounts receivable we just found out, 6,25,000. Debtors they are asking me to find, and bills receivable they have already given it to me. So 6,25,000 minus 60,000 will be my debtors amount. Therefore it will be 5,65,000. It is an important sum. Why important? Because we miss out on these small details sometimes. It's given very much in the question. We have to apply. Okay. Next, EXE Limited, 31st March 2017. Opening stock is given, closing cost of goods sold, stock turnover ratio. What is stock turnover ratio? COGS upon average stock. Average stock, so I can take it from your only opening plus closing divide by 2. That will be 30,000. COGS is given 8 times. So simple. Okay. Now coming to the past exam questions. Alright. Now past exam questions are also very easy. They are big questions, but it's okay. We will be all able to solve it. Okay. When you will solve, you will feel, oh, it's so simple. Okay. Come on. Let's read it. Komal is a third generation businesswoman in the dairy business of Bharat Ghee and Company. The business is run under the brand Pure Ghee. Okay. Company prepares milk-based products and is known for quality in the market. The sales are made through self-owned stores, other retailers at location where self-owned stores are not present, and they are online. The business is run by Komal's family on strategic and operational basis. However, now the business is growing at a rapid pace. There is a need to get in professional management to run this business. Bharat Ghee and Company hires a new CEO, Garima, who has 3 decades of experience in this industry. Okay. Komal will now be executive chairman and provide a guiding role in the business. The first task that Garima has on the hand is to identify the issue that are hindering the business growth. Komal asked Garima to list the major concerns that the business is facing. They are facing lower margins where sales are made through other retailers and online because online platform are charging commission for making sales. High chance of spoilage because it is a perishable product. Capacity increase may be necessitated in the near future, for which capital will have to be raised. Garima requests the accounts head Naina for key financial metrics of Bharat and company. Naina provides these following details to Garima. So now the question starts. Key financials of Bharat, Ghee and company, credit revenue and cash revenue. So total revenue is 80 CR plus 20% of total sales. Okay, cash revenue is 20%. That means total sales is, say it is 100. Okay, so 20% of, so this is going to be balance 80%, no? Correct. So 80% is 80 CR. So 20% will be how much? 20 CR. Gross profit is 30%, indirect expenses 10 CR, tax rate 25, interest on debt is 12%, and interest amount is 12 crore. Debt equity ratio 2:1. Okay, everything is given. Garima does some quick calculations to derive what is the return on equity and return on capital employed. Komal indicates willingness to contribute fresh equity in the business and pay off the loans. However, Garima is not in the favor of repayment of loans. Garima has made a business plan to change this strategy to decrease dependence from the third-party vendors. New plan recommends creation of infrastructure to enable the locations which are serviced by channel partners. A new strategic business unit has to be created for implementation of this business plan. So this unit will require certain facilities, infrastructure facilities, cold chain warehousing 15 crore, new trucks 5 CR, office premises 3 CR, furniture and computers 1 CR. This aforementioned infrastructure will be set up using debt and equity in the ratio of 2:1. The new debt is raised at 14% rate of interest. Average depreciation 30%. The investment of the debt is done on 1st October and company follows April to March as their financial year. Average receivables at the end of the financial year from the new business will be 10 crore 80 lakhs. Receivables turnover days is 45 days. Assume 180 days to calculate receivables turnover ratio. The gross profit margin again 20%. Indirect expenses other than depreciation 2 CR. Income tax rate is 25%. Okay, so now all these details which are given is for this new project, okay, and infrastructure. Komal asked for the projected P&L before approving the required investment amount. First, calculate net profit margin, return on equity, return on capital employed. Okay, if debt is paid off using fresh equity, then what will be the new profit margin and return on equity? Assume debt is paid on the first day of the financial and then comment on the change on return on equity. Prepare projected profit and loss account of the new business unit. You see, this is for 15 marks. Compulsory question. So 15 marks here. 15 marks I have already done with your issue of shares. Another 10-15 marks we have done with consolidation. Okay, so 45 plus 5 marks of your cash flow. 50 marks is already been solved in your marathons. Okay, so now understand one thing. Okay, this is question number 2. So this is your first question. In my first question, whatever ratios I want, I can take it only from here. Okay, so I have made this in the books of Bharat Ghee. First we will solve what? We will first try to calculate net profit margin, return on capital employed and return on equity. I am focusing on my question number A. This one. Profit margin, return on equity and capital employed. Okay. Everything I have written over here. Now cash sales and credit sales. They have given me credit sales as 80%. Okay. So balance 20% will be the cash sales. No. I am keeping this open over here. We are referring to this table right now. So 80 crores is my credit sales, which is 80%. So 20% will be how much? Obviously 20 crores. So total sales is 100 crores. Done. Easy. Gross profit they have given me, it is 30% of my total sales. So simple, 100 CR into 30%, 30 crores. Here, I used this, no, 30%. This is done, this is done, this is done. From my gross profit, if I'll remove my indirect expense, I will get my profit before interest and tax. Indirect expense 10 CR is given. Remove it, minus it. Profit before interest and tax 20 CR. Less interest on debt. Even that they have calculated. See, interest amount 12 crore. Interest rate is 12%. Very good. So 12% it is already given to me. Profit before tax 8 CR. Right? Profit before tax is 8 CR. Less tax 25%. Again this is given to me. So 2 CR. Profit before tax is 8 CR. Minus 2 CR. 6 CR is my net profit after tax. Now I need to know how much is the debt and how much is the equity. That debt amount is not given. Debt equity ratio is given. Debt amount, how will I come to know? When I know the interest amount. Okay, whenever I calculate interest, what I do, interest amount, how I get? I say debt amount, debt into interest rate. Right? Now debt amount I have. Okay, interest amount I have, debt I don't know, interest rate also I have. So what I will do, amount upon the interest rate, I will get the debt amount. Na? That is what I have done. Interest divide by interest rate, interest amount, divide that by the interest rate. So it will be 12 CR. Interest amount, divide by 12%. 100 CR is your debt. Okay. And debt equity ratio is 2:1. That means for every 2 of debt, you have 1 of equity. That means 50%. So if debt is 100, so how much will be my equity? 100 divided by 250. So debt equity ratio is 2:1. Therefore my equity will be 50 crores. So 100 crores plus 50 crores is my total capital employed, 150 CR. Now I have everything with me to find the ratios, 3 ratios. Net profit margin, net profit after tax upon total sales. What is net profit after tax? 6 CR upon total sales. Total sales is here 100. 6 upon 100, 6%. Return on equity will be profit after tax upon total equity. Net profit after tax 6 CR. Total equity is 50 CR. 12%. 6 divided by 50. 12%. Return on capital employed is NPBIT. Net profit before interest and tax. That is how much? 20 CR. Net profit before interest and tax is 20 CR. Here. This one. Net profit before interest and tax divided by total capital employed. We calculated here 150. See, 20 divided by 150, percentage 13.33%. Done. Your first is over. Question number A. All the 3 ratios are done. Same thing. Now they are asking me that, say on the first day we paid the debt. So now there is no debt. So then now what will be the new profit margin and return on equity? Okay. So same thing. I have made it again. See, cash sales, credit sales, total sales 100 CR. Gross profit 30% of the total sales 30 CR. Less indirect expenses. Net profit before interest and tax. Interest will be nil now because we have paid the loan on the first day. So profit before tax and profit before interest and tax, same thing, 20 CR. Tax will be 25%, which is 5 crores. Profit after tax amount will change, 15 CR it will become now. Loan is repaid, so debt is 0. Therefore, total equity will be 150 now. So, net profit margin will be net profit after tax, which is 15 crore, divided by total sales, so will remain 100 only. So, 15 divided by 100 is 15%. Return on equity will be your profit after tax upon your total equity. How much is your profit after tax? 15 CR. Total equity is 150. 10%. Easy? Okay, now we have to compare the ratio. What has happened? Comment on the change of return on equity. Now, return of equity, when there was debt, I had 12%. But now, it has become 10%. Why so? Because you have repayment the debt. Since your debt is repaid, your number of shareholders also have become more. And there is no interest, so that you can get some tax benefit. See this. Tax is 5 crores. Right? Over there, how much tax was there? Okay. Less tax, 2 crore. So you do not get any tax benefit also, na? Since we do not get any tax benefit, obviously we will have a less. That is why debt equity ratio is 2:1. That is ideal. As there is no interest, the tax benefit is also not there. Therefore, there is a decline in the return on equity. You can write in your own words whatever you feel correct. Okay. So number B is also done. Easy now? Now see, they are telling me projected P&L of new business unit. Okay. Fine. So I will come to the new business unit over here. Okay. Now new business unit, how much is the capital needed? 15 plus 5, 20 plus 3, 23 plus 1, 24. 24 crores I need, and that they are telling do it in the form of 2:1. 2 for debt, 1 for equity. That means 16 lakhs, 16 crore debt, 8 crores equity. That debt is going to be at the rate of 14%. Okay. So projected P&L of the new business unit. Okay. We'll have to do turnover, whatever is the turnover. That means sales, total sales minus gross profit. Have they given me the gross profit ratio? Yes, they have given me gross profit ratio also. Then from there I will have to remove my depreciation, and other indirect expenses are given. Other indirect expenses is given, but depreciation I'll have to find. Sales I don't know, I'll have to find. Gross profit is given. Then interest amount also I'll have to find. All this I'll have to do as form of working note. So first I'm taking you all through the working note. Okay. Alright. Now how will I find my turnover? Turnover will be nothing but they have given me average receivables. See, they have told me that average receivables for this new business unit is 10 crore 80 lakhs, and the receivables turnovers days is 45 days, and they have assumed 180 days to calculate this. That means what? Your average receivables is given, receivable days is given. What is your receivables turnover ratio? 180 divided by 45 turnover. In how many days times are you turning over your receivables? 4 times. Okay. So your average receivables into your receivables turnover ratio. I can find my receivables turnover ratio, right? So in that case, 180 divided by 5 is 4. I got this. Average receivables is given to me. Therefore, my turnover will be how much? 43 lakhs 20,000. Sorry, 43 crore 20 lakhs. So I get my turnover 43 crore 20 lakhs. Gross profit 20% is given. Therefore, this is so 8 crore 64. Now, capital investment and depreciation. They have told me depreciation is 30%, but I'll have to calculate. My total assets are 24 crores. Depreciation rate is given 30%. But all this has happened on 1st day of October. The above investment and raising of debt both has happened on 1st day of October. So depreciation also will be from 1st October to 31st March for 6 months. Therefore, amount of depreciation will now be only 3 crore 60 lakhs. 6 months only. Indirect expenses 2 crores is given. Therefore, profit before interest and tax will be 3 crore 4 lakhs. Now, interest working note. Calculation of capital structure and interest. Debt equity given 2:4. Total amount of capital is 24 required, I told you. So, debt will be 16, equity will be 8. Interest is 14% of 16 crore, 2 crore 24 lakhs. But this is for full year, 1 year. Right? I need only for 6 months because from 1st October. So, it will be half, 1 crore 12 lakhs. So, your interest figure also 1 crore 12 lakhs. Profit before tax is 1 crore 92 lakhs. Income tax rate is 25%. Therefore, profit after tax is 1 crore 44 lakhs. That is the estimated P&L of the new business unit. All three done. Okay, so though the question looks very big, but everything is there in the question. We have to just put and solve it. Only this was tricky. Average receivables and receivables turnover. So your turnover times 180 divided by 44. 4 times. That means your turnover will be 4 into this receivables 10 crore 80 lakhs. You get your turnover in that. Okay, this was only tricky, I think, in this sum. Otherwise, everything was fine. Question number 2, very easy. Opening inventory, purchases minus closing, sales return. We have to calculate inventory turnover ratio and gross profit ratio. Okay. Cost of goods sold. Gross profit ratio, I'll need COGS. Opening inventory plus closing minus plus purchases minus closing. I'll get my COGS. Opening given, purchase is given, closing is given. COGS is 9 lakhs. Okay. Average inventory will be what? Opening plus closing upon 2. Opening is also given, closing is also given. Divide that by 2, I'll get average inventory. So, I have my COGS and I have my average inventory. So, inventory turnover ratio will be COGS upon average inventory. 3.43 times. Easy. Okay. Now, sales and sales return both they have given me. Therefore, my net sales will be how much? 15 lakhs. 15 lakhs 60,000 minus 60,000. My net sales will be 15 lakhs. Gross profit will be net sales minus COGS. 6 lakhs. Therefore, gross profit margin will be gross profit upon net sales. 6 lakhs divided by 15 lakhs, 40%. Okay, so both done. Easy sum. 3 marks. Okay. Now question number 3. Again some big sum is come. Okay. Prabhuji is the first generation entrepreneur engaged in bakery business. He is the proprietor of B & Sons, a Mumbai based concern manufacturing bakery products, confectionaries and sweets. Products are manufactured and sold in a wholesale and retailer under a brand name of Bread & More. Products are essentially sold to retailers who would sell that to the final customers. Okay. Since the year 2020, the next generation of Prabhuji's family started participating in the business. New generation is technologically aware and suggested direct sales to the customers through online channels, omni online channels. The bakery brand was also known locally. However, due to sales online and due to good quality of the products, the bakery products started gaining traction nationally. Demand for the products increased. As a result, there was a need to increase the manufacturing capacity. See, something similar which we did with that Komal and Naina and Garima Ghee business. The new members in the business suggested borrowing or setting up a special purpose vehicle for new manufacturing unit. Private equity players can then invest into this SPV. Prabhuji is conservative businessman while not being averse to expansion. Prabhuji suggests minimization minimizing the need of external finance while relying more on internal accruals. Okay. Some financial details: inventory 1st April 22 and inventory 31st March 23. Opening, this is closing. Revenues means sales. Okay, so total sales is 25 lakhs, out of which 80% is on credit. Purchase, wages, carriage inwards. Receivables, opening, this is closing. Total assets, administration expenses. We have depreciation, finance charges, interest. Total debt, total equity and tax. Everything is just given to us. What they want from us. Let's read. Jimmy Shah is a financial expert and a consultant and is a school friend of Prabhuji. One of the key questions was improvement in cash flow. Jimmy Shah made a suggestion regarding study of working capital management. A number of firms ignored the funds balance in working capital. Prabhuji was also concerned about the return on the funds invested in the business as capital. Jimmy Shah advised Prabhuji to use Dupont Analysis to check whether funds are used efficiently. Prabhuji mentions the increase in demand and possible need to increase the capacity. The various options are available to meet the demand. Either you outsource the productivity to the third party. Second option is expand the production capacity and incur a new certain capital expenditure. There are concerns around the manufacturing quality if production is outsourced. The cost of additional capacity is likely to be substantial. A capex capital of 5 lakhs financed by 80% debt and 10% in the remaining. Okay, 80% debt rate by 10% interest. Remaining through equity share is required. Financial projection is as follows. Currently, the revenue was standing at 25 CR. New, it will increase by 30%. Total assets 24. New will be 26. Administration expenses 2 lakh 50, which is given. 2 lakh 75 will be new. Depreciation new will be 3 lakhs. Financial charges 50,000 will stay, but plus interest on the new debt. Total equity 20 lakhs. New equity amount. Total debt is 4 lakhs. Tax 30-30. Gross profit ratio remains the same as previous year. On the basis of the information, answer the following questions. Calculate inventory turnover, average collection period, and then interpret the ratios. Then calculate return on equity by using Dupont analysis. Comment on how this can be improved, and then prepare estimated P&L account and what will be the owner's capital as on 31st March 24. Again 3 questions. Okay, fine. In the books of B and Sons, first thing they want inventory turnover ratio. Alright, inventory turnover ratio is COGS upon average inventory. COGS I can easily find. Average inventory is opening plus closing divide by 2. So first let us find COGS. COGS is opening stock. I'll keep this table here. Here. Everything is over here for COGS. So opening stock 1 lakh, add purchases, add all the direct expenses, which is wages, carriage inwards, add it, minus your closing stock. That will give you a COGS which is 17 lakhs. Average inventory opening plus closing upon 2, 1 lakh plus 2 lakh upon 2, 1 lakh 50. So COGS upon average inventory 11.33 times is my average inventory turnover ratio. Receivables turnover ratio, credit sales upon average receivable. How much will be the credit sales? They have told me my revenue is 25, 80% is on credit. So 25 lakhs into 80%, 20 lakhs. And average receivables will be opening plus closing upon 2, both is given to me, opening closing. 2 lakh 50 plus 3 lakh divided by 2, 2 lakh 75. So 20 lakhs divided by 2 lakh 75, 7.273 times. So simple. Okay. Then they have told me to calculate what? Average collection period, no? Inventory turnover and average collection period. So average collection period will be 365 days. Number of days, 1 minute. Okay, 365 days upon the receivables turnover, which we just found out. Average collection period. It is same, no? We have to just do 365 upon receivables turnover. So it is going to be 50.19. So actually approximately 51 days. Now, after doing this, they are saying interpret the ratios. Now, interpretation I have given it to you all over here. You can write in your own words. First one is your inventory turnover ratio, which is 11.33 times. This has a room of improvement. Means what? Inventory are in the go down. They're staying for 365 divided by 11.33, 32 days. So they should aim to reduce the inventory days with better planning of raw material utilization and demand in the market, right? Average collection period is almost approximately 50 days. So it takes 50 days to collect on the credit sales. Receivables are on the higher side. 50 days means almost you can say you are closing at 2 months. Planning should be done to improve the collection. Factoring as a strategy can be used to sell your receivables. Okay. Now you have to find return on equity based on the Dupont analysis. Dupont analysis return on equity formula is net profit margin into asset turnover into financial leverage. Okay, asset turnover. Net profit margin we know. We know how to find asset turnover, and financial leverage is also there. Now net profit margin means net profit upon total revenue into 100. What is net profit? Sales minus COGS minus operating expenses. Okay. We already found out. We already found out COGS. We have the amount of sales which is 25 lakhs. COGS we just did 17 lakhs. What are the operating expenses? Operating expenses will be your administrative expense. Okay, then your depreciation. So this is your operating expenses, administration expenses, and your financial charges, operating expense. All this your P&L items. Okay, minus your tax rate. That is what we do, no? COGS minus all your operating expenses. Then you will get net profit before interest and tax. Right, now interest is covered over here only, financial charges. Okay, so directly this is net profit before tax minus tax. So COGS minus operating expense total is 5 lakhs, 2 lakh 50, 2 lakhs plus 50, 5 lakhs. Minus tax rate is 30%. So whatever you will get over here, 25 lakhs minus 17 lakhs minus 5 lakhs. So for 3 lakhs, minus 30%, 2 lakh 10,000 in upon 25 lakhs into 100. So your net profit margin is 8.40. That is A. Operating expense I have given over here. Asset turnover means sales upon total assets. Right. Now tell me total assets they have given me. Yes, they have very much given me over here. 24 lakhs. Sales 25 lakhs. Both is given. So 25 lakhs upon 24 lakhs, 1.042 B. Financial leverage is nothing but your total assets upon your total equity. How much is the total assets? 24 lakhs. Total equity again given over here. So your financial leverage is 1.20. All these three ratios you will multiply. 8.40. It will be in the form of percentage only. But multiply these numbers first. 8.40 into 1.04 into 1.20. 10.5% return on equity as per your Dupont analysis. Okay. So this is done. Then return on equity calculated. An improvement can be made in this. Again they have asked us to comment, no? So how you can make an improvement? By improving the utilization of the asset. Since asset turnover ratio is on the lower side, operation needs to be studied for efficiency. increase in asset turnover will improve the expected return on equity. Small amount of debt increase on balance sheet could help the firm. Increase your financial leverage. Okay, then you will have a better return on equity. Passing on some of the cost to the customers through minor price increases can make the organization more effective. Therefore, since you will have a little bit more price charge, your net profit will also increase. So all the three ratios need to be improved in order to have a better return on equity. Lastly, we have to do the estimated P&L based on this current, and now we have to find the new. You have given me current, I have to find the new one. So particulars financial year 22-23, 23-24, and I have done the comments. Revenue 25 lakhs was there. They are telling me that it will increase by 30%. So plus 30% will be 32,50,000. Okay. Now gross profit margin, they say they will remain the same like previous year. So in the previous year, what was my gross profit margin? What was my gross profit first thing? How much was my COGS? 17 lakhs, no? So 25 lakhs minus 17 lakhs. My gross profit was 8 lakhs. Okay, so 8 lakhs divided by 25 lakhs. What is the percentage? 32%. They are saying this percentage will not change. So now also I will use 32% only. 32% of 32,50,000. So that will give me, see, my gross profit was 8 lakhs, no? Sales minus COGS. I have done it here only for you all. So it will be 10,40,000, 32,50,000 into 32%, 10,40,000. Administration expenses, earlier it was 2,50,000, now it has become 2,75,000. This is given. Depreciation was 2 lakhs, now it's become 3 lakhs. This is also given. So my NPBIT, earnings before interest and tax, earlier it was 3,50,000, now it is 4,75,000. Financial charges was 50, and now it will be 50 plus interest on new debt. Okay. So how much is my new debt? How much debt am I taking? Okay. They are saying capex of 5 lakhs. That will be 80% of debt with 10% interest rate. So 5 lakhs into 80% is 4 lakhs. On 4 lakhs, if I say 10% is my interest, that is 40,000. So now my new interest will be 50 plus that 40. Additional that 10% of 4 lakhs, 90,000 here. So earnings before tax, 3 lakh and 3 lakh 75. Tax rate is same, 30%. So profit after tax. Okay, estimated P&L. Owner's capital as on 31st of March 2024. Equity share capital as on 1st of April was 20 lakhs. They have given me. On 1st of April 22. That means 31st of March. 1st of April 2023. It is 20 lakhs. Yeah. Then profit for the year which I made. 2,62,500 P&L account. And additional equity which I raised 5 lakhs. From that 5 lakhs, 80% was debt. That means balance was equity, no? So this also I will add. So total owner's equity or owner's capital is going to be 23,62,500. Okay, everybody. So we have done this also question now. Owner's equity, profit. All this is done. I have given you all in the answers. Okay. Now coming to question number 4. Following information is provided for X Limited. They have given me a balance sheet. Okay. Shareholders funds Equity share capital divided in shares of face value 10 each, X amount for equity share capital, and preference share capital divided as shares of face value 1000 each, X amount. So total X plus XX. In reserves and surplus, we have general reserve and P&L, 7,800 plus 15,000, 22,800 reserves and surplus amount we have. In non-current liabilities, we have only long-term borrowings. They have not told us how much. In current liabilities, okay, sorry, this has just become a little here. Short-term borrowings, okay, current liabilities is 5,000. Okay, no, 1 second. Short-term borrowings, okay, this is your short-term borrowings. This is your trade payables. This is your short-term provision, and this is your outstanding expenses. Okay, so total of your current liabilities is 8,600. Then in case of non-current assets, you have property, plant and equipment 30, intangible assets 1,000 and capital work in progress 2,500. So total is coming to 33,500. Non-current investments they have not given. In current assets, inventories they have not given. Trade receivables, cash and cash equivalent they have given. So now total also we will not know. We have to complete the balance sheet with all these other information. Investments are fixed income securities and they have an interest rate of 8%. The payout of interest amount is rupees 100 lakhs. Inventory turnover ratio is 5, COGS is 15,000 lakhs. Opening and closing inventory figures are same. Equity share capital of rupees 10 each is twice of preference share capital. Equity share capital is 2 times of preference share capital. Long-term borrowings have an interest payout, interest amount of 1,000 lakhs and rate of interest is 10%. Okay, easy it is, simple. It looks little difficult but it is fine. First I will find out my non-current investment. Very simple, no? Because they have given me my interest received on non-current investment amount is 1,000 lakhs. Rate of interest is 8%. So non-current investment will be interest amount upon interest rate. I have shown you all this before also. Interest amount is 100 lakhs. And interest rate is 8%. So 1250 lakh. So in my this balance sheet, non-current investment is done. Inventory turnover ratio is 5 given. COGS given. Average inventory I don't know. So average inventory will be 15,000 upon 5, 3,000 lakh. When they have told me opening closing is the same. So here also I will write 3,000. So 3,000 plus 5,000 plus 300. This total I will bring it here. So now I know it 8,300. So current assets total I know, current asset side 33,500 plus 1250 plus 8,300. Total will be 43,050. So if asset side is total 43,050, liability side total also has to be 43,050. Chalo, no problem. Next is, so total of the asset side I have done. Non-current assets given, non-current investment and current assets. Okay, 8,300 it is. 8,300. Done. Now long-term borrowings I can find in case of current liabilities. Once I have this, no? So I know the total, I know current liabilities, I know everything. I can just find this. And non-current liabilities, they have given me the interest amount and they have given me the interest rate. Superb. Interest amount and interest rate will give me the figure for the long-term borrowings. How much it is? 1000 divided by 10%. 10,000 lakhs. Simple. Put it over here. 10,000. So from 43,050, remove 8,600, remove 10,000 and remove 22,800. All these figures, no, remove it. Remove this and remove this from 43,050. So your shareholders funds will become, not shareholders funds, your equity share capital and preference share capital will become 1650. See? Equity share capital. Balance sheet liability side total also has to be this. That will be what? Your shareholders capital. Own funds, owners capital, not shareholders funds. I will say owners capital. Owners capital plus long-term borrowings, own capital, plus long-term borrowings, plus reserves and surplus given, current liabilities is given. So your owner's capital own capital is going to be 1650. That means equity share capital plus preference share capital is equal to 1650. In that, equity share capital is nothing but 2 times of preference share. So now I am putting 2 times preference share plus preference share 1650. So 3 times preference share is 1650, preference share is 550 lakhs. Therefore, equity share capital will be 1650 minus 550, 1100 lakhs. So this is going to be 1100. This will be 550. So this total will become 1650. Balance sheet is done. Okay. Equity share capital. There is one extra zero here. Sorry. Remove it, please. I'm extremely sorry. 1100 plus 550, 1650. Reserves and surplus given. General reserve P&L. Okay, so total of the shareholders funds is 24,450. In non-current liabilities, we found out this is 10,000. In current liabilities, this is trade payables, short-term provisions, other expenses and short-term borrowings. 8,600 total. 43,050. Same, you have to just copy paste your entire balance sheet. Plant, equipment, intangible assets, work in progress, non-current investments we found out, inventories also we found out, all this else is given. 43,050 tallied. Obviously it will tally. That is how we have done the sum. Okay, just we have to fill in the entire blanks. Calculate net profit margin from the given information. Revenue from operations, that is sales, turnover. Cost of operations 10 lakhs. Selling expenses, administrative expenses, depreciation, interest, other income and tax rate is 30%. Okay. Net profit margin is net profit upon total revenue. Sales is 17 lakhs given. Cost of sales 10 lakhs. Gross profit is 7 lakhs. From there, remove selling expense, remove administrative expense, EBI, earning before interest, tax, depreciation and amortization. Remove depreciation given. Interest before EBIT before means in earnings before interest and tax is 2 lakhs. Minus interest, this is also given. EBT is 1,50,000, but there is something over here, other income. So earnings before tax plus I will have to add this other income. So your actual earning before tax is 1,95,000. On that I will apply tax rate. Okay, so this was one small tiny thing. If you would have forgotten this, you would have directly done earnings before tax. tax rate 30% on 1,50,000. No, you will have to add this other income. Okay. So your net profit margin is what? Net profit upon your total revenue. So your net profit includes this profit 50,000. So your revenue will also include this 45,000. Okay. So your revenue will also include, no, when you make this P&L, when you make this profit and loss, you write your gross profit here, you also will write your other income, na? So basically your total revenue will include everything, no? Your sales plus your other income. So net profit is 1,36,500 after tax. Upon total revenue will be 17 lakhs plus 45,000. Okay, so 7.82%. Total revenue and not net profit includes other income. This is given in your guideline answers with the note. Okay. Next. Okay, following summarized balance sheet, following summarized statement, P&L and balance sheet is given of ABC for year ended 31st of March. Amount in crores, sales, add back other income, less cost of sales, you get gross profit margin excluding other incomes. Okay. Okay, so sales minus cost of sales, they have taken gross profit. See, 144 minus 110.02, 33.98, na? 144 minus 110.02. Yes, this they have taken sales minus cost of sales. Yes, only then you will get gross profit. Other income is going in the P&L item. No, it is in gross profit, then you add this other income. In operating expenses, you have administration, selling and distribution. You get profit before interest and tax. Minus interest, you get profit before tax. Then you have provision for tax, profit after tax. In case of balance sheet, we have fixed assets 37.5. In current assets, inventory, receivable, cash at bank. Current liability is 11.25. So your net current assets is 22.57. Okay. Total assets will be 60.07. Why total assets? Net current assets plus your fixed assets. Liabilities and owner's equity, they have given separately. Share capital, reserves and surplus and long-term debt. So your total is again 60.07. We have to find current ratio, liquid ratio, gross profit margin ratio, net profit margin ratio, return on equity. Okay. Okay. Current ratio is what? Current assets upon current liabilities. They have given me my current assets here. Inventory, accounts receivable and cash at bank. 1, 2 and 3. 16.64, 15.43, 1.75. What is current liabilities? Also they have given it to me. All is given. So current ratio is current assets upon current liabilities. 3.01 is to 1 times. Liquid ratio will be liquid assets upon current liabilities. Which will be the liquid assets? I will not take inventory. Accounts receivable plus cash and cash equivalent. That means 15.43 plus 1.7. 17.8. Divide by current liability, liquid liability, one and the same thing. So 1.53 is to 1. Then what they want? Gross profit margin ratio. Come here. How much is the gross profit? 33.98. Given. Net sales given. Margin you can just find it out. 33.98 divided by 144%. Okay, 23.60 approximately. Net profit margin, net profit after tax divided by net sales. Net profit after tax also they have given it to me. 15.78 divided by 144%. 10.96. You didn't have to make even the income statement. Return on equity will be profit available for equity shareholders upon equity shareholders funds total. What is the profit available for equity shareholders? This only, net profit after tax. How much equity shareholders funds we have? Equity share capital plus reserves and surplus. 27 plus 6.36. 33.36. So 47.30%. Total equity is what? Equity share capital plus reserves and surplus. Done. Return on equity. Current liquid gross profit, net profit, return on equity. Question number 6 is also over. Okay, 5 marks. 1 mark for each ratio, which everything is given in the problem. Nothing is to be done. No, there are no adjustments only, na? So obviously you have to take everything from this. Okay. So with this, I have completed your ratio analysis also. Okay, ratio analysis. All these notes you will get it on my Telegram channel. Okay, so join the Telegram group and you will be able to avail all my notes for all the marathon class. Okay, thank you everybody. Thank you for being there. All the best. Bye.